It's kind of a strange thing, though, isn't it? I mean, we had the scare at the end of last year with quite a dramatic pullback in the market leading into Christmas, nearing that 20% correction, bear market watermark. Do you think that this rapid recovery we've had in the market, do you think that it's made investors complacent again? Or,
no, I don't think they're complacent. I actually think that we're hearing from our customers. I mean, in January, February did the same thing, and it caused people to wake up a little bit, and then of course Q4 did it again and caused people to wake up again. And I think that more of anything else, the complacency is coming away, subsiding. I still think that there's a lot of, kind of that conventional wisdom mindset that is in the marketplace. And, it's easy just to kind of go along with it. And, I was just say it's easier to fail, along with a conventional thought than sort of, try to, succeed by being unconventional. And I think that's a real issue that our industry faces. And so I do think that this is a time for people to step back and really think about the way that they're building portfolios. When I think about the risks in the marketplace, there are real risks that we can see, and not to become complacent. And so as a risk manager, look, we never want anybody to be losing money. We want people to be making money, but we need people to actually wake up and recognize that risks are a part of it. Now, you talk about the scare of Q4. I mean, it's kind of like giving people $300 and taking away $200, and that's the way that sort of December came in and October came about. The reality, people are still positive, and most should be doing well. It's a reminder, though, that it isn't just a one-way game. It's a two-way game, and you got to be willing to protect that capital that you generate and the returns that you are able to sort of create as time goes on, and continuously having that mindset of protection. Protect what you've got, protect what you've made is a really important principle that everyone needs to be thinking about. So, this is a time to be, really strong in that opinion, despite a strong January that has kind of gotten people back into this, okay, that's over with. No, it's not over. None of the markets is ever over. It's always got basis of risk. And the reality is when we're in the 8th or 9th or 7th, whatever inning people want to argue that they're in, I can tell you we're not in the first or second. So whatever inning we're in, you want to be thinking about late game strategy.
The pullback was certainly a test for investors to find out if their portfolios were well structured.
That's right.
And at the same time with fixed income, I think there was this angst sort of at the end of last year as to, where do you go with your fixed income? If rates are rising, where do you go?
Yeah.
And of course with the market, with the pullback in equity markets, initially a lot of money was going into short-term instruments because of that sort of challenge, that quandary. Where do I put, the fixed income money if the market's going sideways or down? If the bond market, if interest rates are rising and equity markets are falling at the same time, it seems like there was nowhere to go except cash for a while, right?
That's what we have to remember. We're in a different interest rate cycle than we were in 1990 and in 2006, and we're in a very different world. And so you've got a low interest rate environment. Interest rates may go up and down or go flat, but the reality is there's not a lot of return per unit of risk in interest rates in bonds. And so it really, what I think the most unsettling part of, this is that, yes, that conventional wisdom of, when equity markets fall, my bonds will protect me. Well, for 11 out of 12 months of 2018, bond markets actually were as bad or difficult as equities were. And so, only in December.
There was the anticipation that rates were rising.
Only in December, that's right. Otherwise, actually, interest rates and bonds were unprotective and hurt you just as much. And so, I think, again, that's the reality of where we are. And if we go into 2019, I'd say that one thing that we can say for certainty is that the fixed income markets will be a low return, high risk environment for most investors. And an environment where most people will be really challenged to meet their long-term liability from. And so we have to, the same way we made this call 2.5 years ago, we kept telling people that the bond market is a poorly structured part of your asset portfolio. We need to rethink all of this stuff. And so, everybody needs to rethink this. And let's get out of that conventional wisdom that a 60-40 portfolio is going to protect me into, periods like Q4.
Yeah, so as I said initially, a lot of money was going to short-term instruments because of that catch-22.
Yeah, I would do the same thing.
Ultimately, if you were in the longer end of the bond market, 10 years plus in treasuries or
for 1 month out of 12. That's the problem. It's kind of like buying insurance, you know. You buy insurance and the key with insurance is not overpaying for it. So, meaning that you don't put too much of your assets in it. So if I want to buy $1 million of insurance against myself, I don't go and pay $10,000 a month for it, right? Otherwise I'll never make it. It's useless. But if you pay $300 a month or $200 or $50 a month or whatever it be, then you can articulate, okay, that makes sense. The reality is the same thing. If I go put 20 or 30% of my portfolio in a money-losing segment of the marketplace, meaning I've got very bad return and risk rewards, and I keep that there for that one moment when it's going to protect me, it doesn't make economic sense for the whole long-term portfolio model.
Okay.